Fair value gaps tell you everything you need to know in the market. This also means fair value gaps tell you which fair value gaps are valid, which fair value gaps will be traded back into, and which fair value gaps will fail. Fair value gaps are one of the most key aspects to becoming profitable in today's market. Time and time again, I say all you need is fair value gaps. Once you master fair value gaps, you will notice a significant improvement in all your trades. So without further ado, let's get straight into it. Before we trade fair value gaps, it is important to understand what is a fair value gap. Now, fair value gap, imbalance, inefficiency, if you ever had any of these terms floating around, they are all referring to a fair value gap. Now, a fair value gap simply forms in a market situation where the supply of buyers is significantly higher or lower than the demand of sellers. Now, this surge in buying pressure causes market to move too quickly, leaving behind a gap in the market. Now, this gap is what we refer to as a fair value gap, an imbalance and inefficiency. This is showing it right here. So this scenario has just described a bullish fair value gap. Now, if the demand of sellers is significantly higher than the supply of buyers, this will form market to move too quickly to the downside, forming a bearish fair value gap. Now, how can we use this knowledge to our advantage? Fair value gaps are a magnet area for price, as market must fill this inefficiency in the market before continuing in the desired direction. So if market was moving bullish, if we had a bullish trend, we would assume market has to fill this fair value gap before continuing in its desired direction. As I briefly explained earlier, a fair value gap simply on your chart is a free candle formation, candle A, candle B, and candle C. This is the basis we are going to use. So we need an expansive B candle that leaves behind a gap. Now, what does this mean? Now, on this diagram, we have two fair value gaps right here. This is our candle A, this is our candle B, and now this is our candle C. A, B, C. This is a free candle formation with the B candle forming our fair value gap. This B candle is expansive. As you guys can see, we get a big push upwards, leaving behind a gap. This is simply our fair value gap. Now, on to the third and final point. We want no mitigation back into our point of interest. So if market would come, right here would play out, market would come, touch this fair value gap, start moving upwards. This fair value gap is no longer valid. We cannot trade back into it. Now, again, if I show you onto the second fair value gap right here, candle A, candle B, candle C. We mark out our fair value gap from the high of candle A to the low of candle C. Or if we are marking out, say, this fair value gap, for example, which is also a valid fair value gap, we have candle A, candle B, and candle C. We mark it out from the low of candle A to the high of candle C, or from the high of candle A to the low of candle C. The gap in the middle of candle B is our fair value gap. Now, what do fair value gaps show? Fair value gaps show displacement to a certain bias, indicating a move to a further target. Now, the nature of fair value gaps is they are quite expansive. As you guys can see, fair value gaps move with a lot of volume to one direction. So in this case, I can assume market is bullish as we have a lot of volume to the upside. So a successful fair value gap forms more fair value gaps. So from here, I would assume with market moving with a lot of pressure to the upside to come fill our fair value gap before continuing upwards, maybe leaving a fair value gap right here, returning to this one, moving upwards. So now once you've finished watching this video and you are a master at fair value gaps, you'll be able to see which fair value gaps can indicate to us if a market is expanding or retracing. So understanding the behavior of fair value gaps, such as if market were to not respect this fair value gap, what would it mean for this fair value gap? If market were to disrespect both these fair value gaps, what would it mean? Now, as I said earlier in the video, fair value gaps is all you really need. We can use fair value gaps for basically everything. Directional bias, entries, take profits, and then as an indicator of price action. Now, fair value gaps are the perfect strategy to becoming profitable in 2024. However, we as humans are not perfect. We make mistakes. We do not know how to identify fair value gaps properly. Now, why is this? One of the main reasons is because market is not always going to be picture perfect. Now, in these diagrams, the fair value gaps are very clear. However, market will not always be like this. It is important as a trader to have the skills to adapt to the everyday market and to see what is happening in the market. So with that being said, I'm going to hop onto the live market and see what I see when I look at a chart and how I identify fair value gaps. Now, in order to be successful when trading fair value gaps, follow these simple rules. Now, rule number 1, fair value gaps that break a significant level of structure have a higher probability to continue. Now, after watching tens of thousands of candles print out live in front of my own eyes, This is a pattern I have realized. Let me show you a few examples on the market. Now, starting right here, we do have market form a fair value gap where we do display below this low. You could even say we displace below this low right here. So this fair value gap displaces below this low. We get a break in a significant level of structure. And as you can see, market comes, respects the fair value gap before taking the next point of liquidity. So moving on to the next example right here, this fair value gap. As you can see, this is the candle that breaks above this high right here. We do break above a significant level of structure, to which market respects this fair value gap again, to then we get market come to the next level of liquidity to come take it out. So an example where market does not break structure, you'll see, such as this fair value gap right here. We do not really have this candle breaking above any significant levels of structure or liquidity. And as you can see, the fair value gap is not respected very well. So just a general rule of thumb, any fair value gap that breaks a significant level of structure has a higher probability to continue, where you can see that again right here. Break above this candle high right here, where market comes, taps into the fair value gap, and we do continue. Now, why is this? Firstly, when we have a fair value gap form, we have these displacement candles form, and we are displacing above a high. It gives us confirmation that market does want to move higher. Now, what's a telltale sign that market is bullish in our example or bearish? To see if we are bullish, we want to see market displace above highs and create fair value gaps, where market come fill these fair value gaps before continuing in the desired direction. So if we are taking liquidity to the upside and filling PD arrays to the upside as well, that is a sign that we are bullish. Now, the second step is to use PD arrays with your fair value gaps in order to increase probability. Now, what is a PD array? A PD array is simply a target in the market, a magnet area for price to attract to. So examples of some PD arrays are breaker blocks, old highs and old lows, candle high or candle lows, and liquidity voids. Now, with each fair value gap, as a trader, how are you meant to know if market may simply touch into the entry of our fair value gap, or if market may fill our fair value gap completely? How are you meant to know as a trader? Now, this is what we use. We use an additional confluence such as a PD array. Now, my favorites are breaker blocks and old highs and old lows, or candle high and candle lows. So in each fair value gap, say for this fair value gap, for example, we do have a breaker block you could have used in order to increase your accuracy of your entry. Now, as you guys can see, market comes into our breaker block and then reacts off of it. Now, if you were to enter off the 50% or even the entry of the fair value gap, it still would have been valid. However, it would have been a less precise entry. Now, for this example right here, simply the PD array we are using is an old high or candle high. So as you guys can see here, market comes, taps into our candle high before reacting off. Now, as you guys can see how precise this really is. Now, onto our third example. Now, this one is not as clear. However, you could have used, now if you hop into the 4 hour, it would possibly be more clear. As you guys can see, we do have this fair value gap right here, or you could say this is the candle low, the previous candle low. So back onto the 1 hour time frame, you can see market comes into this area before reacting off of it. Now, it is as simple as that. If you use this in confluence with your fair value gaps, you'll be a lot more precise and a lot more accurate. You'll stop getting into drawdowns. So on to the third step. If a fair value gap fails, aim for the next point of liquidity. Now, this sounds simple, but what do I mean? Now, firstly, fair value gaps are not always going to be perfect. Sometimes they will fail on you, but you need to understand what to do when this happens. This does not mean all hope is lost. It just means there's more opportunity in the market. Now, I'm looking at this fair value gap, for example, and now market is playing out. And I can see market is not really giving me a good reaction right now. There's a lot more pressure towards the upside. Market is forming fair value gaps to the upside. So if I play out market, I can end up seeing market is not respecting this fair value gap. I need to see where market is headed next. Now, we know liquidity is a magnet area for price. It attracts price. So wherever there's liquidity, price is headed there. So as you guys can see here, I'm going to aim for my next point of liquidity, as I know market will come and take out the next point of liquidity. And the next probable point of liquidity is this high right here. So if I play out market, you guys can see market does take out this high right here. Now, with a failed fair value gap, now what you can do is you can still trade off of it. Now, I know this goes against what I teach. However, this is an actual concept called an inversion fair value gap. So when a fair value gap fails, we can extend this right here. We can extend our box, our fair value gap, and wait for market to come back into this price. Now, an inversion fair value gap or an inverse fair value gap is simply when a fair value gap fails and we get that change in momentum towards the upside in our case. We have market come, return back to this zone before reacting off it. Now, if this were a bullish example, and this was our fair value gap, and we expected market to react off this fair value gap. However, market smashed through price, came back to our fair value gap before reacting off this zone again and continuing to the downside. This would be an inversion fair value gap, however, a bearish one, whereas this is a bullish one. Now, if we use this inversion fair value gap plus aiming for the next point of liquidity, we can now frame an entry. This is one example how you could place a trade using this concept. So now aiming for this liquidity point for a nice 1 to 2. Simply if I play out market, as you guys can see, we already do get our entry, and boom, full take profit like that. And we could have ran to another point of liquidity such as this point right here, as you guys can see. So now just like that, using an inverse fair value gap plus liquidity, we were able to catch such an amazing trade. It's as simple as that, guys. If a fair value gap fails, it does not mean all is over. Now, I'm going to show you guys a couple more examples on how you can use all these steps together in order to frame a bias, frame trades, whatever you guys are looking at. So let's get into it. Now, using all the steps I've taught you in this video, I'm going to show you guys a trade example. Now, this trade was actually sent out to the group. However, I'm going to be going over a few things I could have done better using these 3 steps. So to start off, we do have a fair value gap right here, which I have clearly outlined. And as you guys can see, we do break above a key level of structure, which is our rule number 1. Now, rule number 2, using another point, another PD array in order to get a more precise entry. As you guys can see, I did use this low right here, which did help. Now, waiting for market to tap into this fair value gap. Now, we are on the 1 hour time frame, waiting for market to tap into this fair value gap. If I do play it out, you guys can see, boom, we do tap, and we do get a nice reaction of this fair value gap, which then prompted me to drop down to the 5-minute time frame. Now, at this point, I was unable to catch the fair value gap entry. There was quite a few which you could have caught. So just to name a few, if you were able to catch this fair value gap, for example, this would have been a great trade right here. Or if you wanted to catch this fair value gap right here, this would have also been great. Now, this fair value gap would have been great as we do have an overlap right here. So in addition to that, we do break above the structure. As you guys can see, this B candle displaces above this high. We are doing our step 1 and step 2. So now if I play out market, you guys can see we do get a fantastic reaction, and market does end up playing to our full take profit. So if I had entered off using the rules I have given in this video, I would have been a lot more successful. I did not take a loss, however. However, if I did follow these rules, I would have been up 1 to 5 RR. So my initial entry was right here of this order block, and we missed it by half a pip. So as simple as that, guys. If you follow these 3 simple rules, you will be profitable using fair value gaps. You can use it for entry, for bias, for anything. On to the next example. Now, on to the next example. As you guys can see, we do have a fair value gap right here. Now, from this fair value gap, I want to firstly see if we do break below a structure, which we very clearly do. As you guys can see, our B candle is displacing below this low, so it does add probability towards this trade. Secondly, where am I going to find a second confluence, a second PD array? Now, we do have 2. We have this breaker block here firstly, and we do also have this low right here. So you could have entered off any of these. However, for the video's sake, let's say we entered off the breaker block as it is the more clearer PD array. So now placing my limit stop loss above the breaker block and take profit for a nice 1 to 2. You guys can see we do get that entry and we do smash full take profit. Now, it's as simple as that. If we did use this candle low, it would have been quite a better entry. However, nonetheless, you would still walk out with profit. So it just goes to show sometimes, even if you do make mistakes, the strategy has room for that. So this is why it is so great. If you have made it this far in the video, congratulations, you are taking your trading seriously. A lot of people are not taking their trading seriously. They will click on the video and click off. Now, as you are taking your trading seriously, if you want to take it to the next step, if you want access to trades where I'm highly profitable, I'm a funded trader myself. Now, if you do have any questions, if you need weekly trade breakdowns, if you need me to analyze your charts, the mentorship is at an insane discount right now. $97 for lifetime. Now, this price will be going up to $100 a month soon by next week. However, for the first week, we are at $97 lifetime. So join if you are interested. Simply click the first link in the description or message me at Telegram for any more details. Thank you guys so much for watching, and I'll see you guys next time.